Imagine waking up one morning and discovering that the company you use every day has made someone else millions. You bought the phone, you paid for the subscription, you ordered the delivery, you used the bank, you bought the sneakers, but someone else owned the machine producing all that money. That is the strange part about wealth. Most people spend their lives being excellent customers of businesses they could have partially owned. And this is where stocks become interesting, because a stock is not just a flashing number on a screen, it is ownership, a tiny piece of a real business. And once you understand that, the stock market stops looking like a casino and starts looking like something much more important, a machine for transferring business profits to people who own productive assets. But there's a problem. Most people approach stocks backwards. They ask, which stock is going up? The better question is, what business am I actually buying? That difference can separate investing from gambling. And later, we'll get to the one mathematical advantage that makes long-term stock ownership so powerful, and why starting early can matter more than starting with a huge amount of money. Let's start with the simplest possible example. Imagine there's a small company selling bottled water. It makes $100 million in revenue. After paying employees, rent, transportation, taxes, equipment costs, and everything else, it keeps $10 million as profit. Now imagine the company has 1 million shares. Each share represents a tiny claim on that business. If you own 10,000 shares, you don't own a random digital number. You own a small percentage of the company. That means you have an economic claim on what the company eventually produces. This is the first principle, ownership. When you work for money, you sell your time. When you own an asset, the asset can produce money without requiring you to personally perform every task. That distinction becomes enormous over decades, because your day has a limit. A company doesn't have the same limit. It can have thousands of employees, millions of customers, factories, software, distribution networks, brands, patents, and systems all working simultaneously. That is leverage, and public companies allow ordinary people to participate in that leverage. But here's where most people get this completely wrong. They think the stock market is mainly about predicting prices. It isn't. The price is what people are willing to pay today. The business is what actually creates value over time. Those two things can separate dramatically. A company can have an incredible business and an absurdly expensive stock. Another company can have a boring business and a surprisingly attractive price. That's why investing requires you to look underneath the ticker symbol. Consider what happens when a company grows. It earns profits. It can reinvest those profits into opening new stores, building technology, hiring people, acquiring competitors, or developing new products. Those investments can generate even more profits. Then those profits can be reinvested again. This is compounding, and compounding is basically what happens when money starts producing more money and those new gains start producing more money. It sounds harmless. It isn't, because time turns a small percentage into something surprisingly large. Suppose you invest $10,000 and somehow earn an average 10% annually. After 1 year, you have roughly $11,000. After 5 years, around $16,000. After 10 years, around $26,000. After 20 years, roughly $67,000. And after 30 years, about $175,000. You didn't contribute another dollar. The money simply kept working. Now imagine adding money regularly. That's when the mathematics become even more powerful. This is why wealthy investors obsess over time, not because time is inspirational, because time is an economic force. But there's another mechanism hiding underneath all of this. Companies can pay shareholders directly through dividends, or they can keep profits inside the business and reinvest them. Either way, the fundamental question is the same. What can this company do with the capital it has? This is why cash flow matters. Revenue sounds impressive, profit sounds better, but cash flow tells you whether the business is actually generating usable economic value. A company can report beautiful numbers while constantly burning cash.
That's like someone claiming they earn $2 million every month while borrowing $500,000 just to pay their electricity bill. The income sounds good, the economics don't. Almost nobody talks about this part when investing gets discussed online. The quality of the business matters, recurring revenue matters, pricing power matters, distribution matters, brand strength matters, debt matters, competition matters, and scarcity matters. If a company owns something difficult to reproduce, a powerful brand, a massive network, valuable infrastructure, proprietary technology, or access to millions of customers, it may have an advantage competitors cannot easily copy. That advantage can become a moat, and moats matter because capitalism is competitive. If a business makes enormous profits and anyone can copy it tomorrow, those profits attract competitors. More competitors arrive, prices fall, margins shrink, the easy money disappears. The strongest businesses are often the ones where something prevents that process from happening quickly. But now comes the uncomfortable part. A great company can still be a terrible investment. Why? Price. Imagine discovering a wonderful restaurant, fantastic food, loyal customers, excellent location, growing sales. You'd probably want to own it. Now imagine the owner tells you the restaurant is worth $10 billion. Suddenly, the quality of the restaurant isn't the main question. The question is whether the future profits could possibly justify paying $10 billion today. This is valuation, and this is where stock investing becomes less exciting and much more rational. The stock market is constantly asking you to compare two things: what you're paying today and what you expect to receive tomorrow. If everyone already believes a company will become the greatest business on earth, much of that optimism may already be built into the stock price. That's why hype can be dangerous. You can be completely correct about the company and still lose money because you paid too much. Think about it this way. If someone offers you a $1 million asset that produces $100,000 each year, you might consider it attractive. If they suddenly demand $20 million for the exact same asset, nothing about the asset changed, only the price changed. But this is exactly what people forget when a stock is rising. The higher it goes, the more people assume it must be better. Sometimes the opposite is true. Sometimes rising prices simply means expectations have risen faster than reality. This is why investing is partly a study of consumer psychology. Humans chase what is popular. We see a stock rise 50% and suddenly it feels safer. We see another fall 40% and assume it must be dangerous. But price movement alone tells you almost nothing about whether the underlying business became better or worse. A stock can fall because the business is collapsing, or because investors became temporarily pessimistic. Those are completely different situations. And this brings us to risk. Risk isn't simply volatility. A stock moving 10% in a week is uncomfortable, but permanent loss of capital is worse. If you buy a fundamentally broken business, no amount of patience can magically repair it. That's why diversification matters. Instead of betting your financial future on one company, you can own dozens, hundreds, or even thousands of businesses through broad market funds. You don't need to predict which single company will dominate the next 30 years. You can own the system. That is an important form of risk management, and it creates another advantage. You stop needing to be right all the time, because nobody is. The most sophisticated investor on earth cannot predict every recession, technological breakthrough, political crisis, interest rate decision, or consumer trend. But a diversified investor doesn't need perfect predictions. They need a process that survives imperfect predictions. This is where stocks connect to the larger wealth equation. There are essentially two ways to increase your financial position: earn more or own more productive assets. Ideally, you do both. Your income creates the fuel. Your investments determine what happens to some of that fuel after you receive it. If every increase in income immediately becomes a more expensive lifestyle, your financial position may barely change. You earn more, you spend more. You repeat. That's lifestyle inflation. Assets work differently. An asset can potentially create cash flow, appreciate in value, or both. A liability usually demands cash from you. That doesn't mean every expensive purchase is bad. It means wealthy thinking asks a different question. Is this purchase consuming wealth or helping produce it? And this is where stocks become particularly interesting for people who want time freedom. You don't have to manage a factory. You don't have to hire 500 employees. You don't have to negotiate with suppliers. You don't have to personally deliver products to millions of customers. You can own a fraction of the system. That is the quiet power of public markets. But don't confuse simplicity with certainty. Stocks can fall, sometimes violently. Businesses fail. Markets crash. Recessions happen. Entire industries disappear.
The stock market doesn't reward you because you deserve it. It rewards you for owning productive assets and accepting the uncertainty that comes with ownership. There is no guaranteed return. There is only a long-term relationship between risk, ownership, cash flow, and time. And now we can return to the mistake that destroys many people's chances of building wealth. They wait for certainty. They want to know which stock will win. They want to know when the market will crash. They want to know the perfect entry point. They want to invest only after everything looks safe. But markets rarely look safest when opportunities are greatest, and by the time certainty arrives, prices may already reflect it. The more useful approach is boring. Understand what you own, control your costs, diversify, invest consistently, give compounding enough time to work, and don't confuse financial entertainment with financial strategy. Because the biggest wealth-building advantage isn't knowing tomorrow's stock price, it's owning productive assets long enough for their underlying economics to matter. That is the real lesson. Stocks are not magic tickets. They are claims on businesses. Businesses create products. Products generate revenue. Revenue can become cash flow. Cash flow can be reinvested. Reinvestment can create growth. Growth can increase the value of ownership. And over long periods, compounding can turn that cycle into something much larger than the original investment. 5 years from now, two people can look back at this exact moment. One spent those years chasing whatever stock was trending that week. The other spent those years learning how businesses make money, managing risk, buying productive assets, and allowing time to do what time does. Neither knows exactly what the market will do. That isn't the point. The difference is that one was trying to predict the future. The other was building a position in it. So the practical next step is simple. Before buying any stock, stop looking at the chart first. Look at the business. Ask what it sells, how it makes money, whether customers keep coming back, whether it generates real cash flow, how much debt it carries, what protects it from competitors, and most importantly, what price you are paying for those future profits. Because the lesson was never about finding the perfect stock. It was about understanding the pattern behind successful ownership. If this explanation changed the way you see the stock market, like the video, subscribe, and comment with the one stock or business you want to understand next. Because once you stop seeing stocks as numbers moving on a screen, a much bigger question appears. If the world's most valuable businesses are going to keep producing wealth, do you want to spend your life buying from them or quietly owning a piece of them?